Hello family, welcome to NQ Daily Market Review. Today the market absolutely melted down, and in this video we are breaking down the institutional narrative behind the crash and analyze how this trade could have been framed using a clear market structure shift that gave us the entry, and most importantly how to identify the drawn liquidity. So let's dive in. As we saw in yesterday's CPI trading session, market trading in a range. It went up, it took buy-side liquidity, and then started to go down. It tried once again to take the high, and it couldn't, so market started to price lower. So if you look right here, this is our market structure shift. So price went to the optimal trade entry, it returned to the SIBI, then it went higher to 1 minute SIBI that was left open, and just to trade lower. So it rebounded a little bit at the end of the session to this very 5-minute order block right there. So if you can see, the position of the 5-minute bearish order block is in very close proximity to your 2022 model short. So there were two signs telling us our bias should be to the downside. So if you analyze that last range, you can measure the range from the low to the high and mark the halfway point, that is equilibrium. So equilibrium is right there, is again in very close proximity to the bearish 5-minute order block. So that is indicating us that price is going to deliver to the downside the next trading day. So actually, when price opened at Asian session, a trade could have been placed there and your stop loss placed just above the 5-minute bearish order block and let it run. But if we go to the New York session, what do we have here? At 8:30, we can see very clearly our market structure shift that indicated us that price was going to continue to deliver to the downside. What are those? Those are relative equal highs. And what's resting above relative equal highs? Buy-side liquidity. So price took buy-side liquidity and made a 2022 model. There's your CB, so that trade was entering short and place your stop loss above the model. If we can see right here in the 1 minute time frame, you can see the same model right there. So the price went down and took that low, then it came back to fill the imbalance, and then it just started to trade lower. So all that price action was telling us that price was going to deliver downside in an expansion day. So the job was then to search for the drawn liquidity to know where the price was heading. So if we look in the longer time frames, we can find this right here. So what is that? This is a volume imbalance. And that right there was our draw on liquidity. So what price is doing is price is returning to rebalance the volume imbalance, because that's what price does. It provides efficient delivery, and it did by filling the volume imbalance. So if we go to the 1 minute chart, and we extend the profit taking to the drawn liquidity. So if you weren't able to catch that entry, the market offered another opportunity to go short. right here. Another YouTube model. There's your VC. And there's your profit taking. So that was a 3x right there. So then price filled the volume imbalance, and after filling the volume imbalance, it made a 2022 model long. This is your low, this is your high, lower low, break of structure, fair value gap, and there's your entry. So you place your entry at the top of the buy side imbalance, sell side inefficiency, and you place your stop loss below the entry model, and you take profit along the way. There's a previous high. You could have taken first partial there, and there's another high to take the rest of the position there. So that trade would have been a 2.3 risk to return ratio. And just for the sake of analysis, the trade that could have been taken in the 5-minute bearish order block in the Asian session, if you identified correctly the drawn liquidity and let it run for the day, it would have been a 17.8 risk to reward ratio. That would have been your month right there. So as a final lesson for today, I want you to focus on the macro narrative following the CPI release, where the market traded strictly within a range between buy-side liquidity and optimal trade entry. We knew the price would eventually have to break out one of those extremes. It did break out through the optimal trade entry because internal price action delivered a clear market structure shift. Signaling institutional order flow was no longer interested in supporting higher prices. This is why defining your drawn liquidity is so important, so that you don't get lost in the noise and you know where the price is heading. So if this breakdown helped you see the market with more clarity, thumbs up and subscribe. I love you.